Here's something I need you to sit with for a second. The median home price in America is now 5 times the median household income. That's not a talking point. That's Harvard's housing research, published last year. 5 times. When your parents bought their first home, that ratio was closer to 3. So the question isn't whether something changed. Something clearly changed. The question everyone avoids is whether it was an accident. It wasn't. Every decision that got us here was documented, filed, signed into law. And by the end of this video, you'll know exactly who made those decisions and what they were protecting. The best way to understand what happened is to look at where we ended up. So let's put the numbers on the board. That is the median existing single-family home price in the United States as of 2024. A record high, according to Harvard's Joint Center for Housing Studies. Now here is the number that tells the real story. 5 times. That median home price is roughly 5 times the median household income. That ratio, price to income, is at an all-time high in American history. Not the highest since the financial crisis, not the highest since the pandemic, the highest ever recorded. And it gets more specific than that. According to the Federal Reserve Bank of Atlanta, a household needs to earn $121,400 a year to afford a typical home today, keeping housing costs below 30% of income, which is the standard threshold for affordable. The average American earns $84,000. That is a $37,400 gap between what the market requires and what the average person makes. And here is the one that I think deserves its own moment: 60% versus 32%. In 6 years. This is not a gap that people can budget their way out of. This is not a gap that a better savings rate fixes. This is structural, and structures are built by someone. So today, we're going to go level by level through what actually happened to the American housing market and who, specifically, it happened to benefit. Level 1 is where most of the people watching this video live. And I want to be precise about what that actually looks like in practice. If you earn $75,000 a year, which puts you solidly in what most people would call the middle class, you can afford 21% of current home listings in the United States. 21%. In 2019, that same income gave you access to 49% of listings. That's not a slight tightening of the market. That is the middle class being cut in half in terms of what they can access in 6 years. And it's not just buyers. If you rent a modest 2-bedroom apartment right now, the hourly wage you need to earn to keep housing costs below 30% of your income, what economists call the housing wage, is $33.63 an hour. The federal minimum wage is $7.25. That's not a gap. That's a different planet. The part that I think gets missed in most conversations about this is what it does to people psychologically. There's a specific kind of exhaustion that sets in when you run the numbers correctly. You're not failing to save enough. You're not spending too much on coffee. You are doing the math accurately and realizing that the math doesn't work. That the goalposts moved while you were running. Existing home sales have dropped to their lowest level in 30 years. That's not because people don't want to buy homes. It's because they can't. The market didn't slow down. The people got priced out. And here's a detail that almost never gets mentioned. Mortgage rates went from under 3% in 2021 to over 6.8% by 2025. What that does to your monthly payment is not linear. It's compounding. A $300,000 mortgage at 3% costs you about $1,265 a month. At 6.8%, that same mortgage is $1,955 a month. That's $690 a month more. $8,280 a year on the same house. So, home prices went up 60%. And then, the cost to finance the inflated price also went up dramatically. The buyer got hit twice, and they were told it was inflation, or remote work, or millennials not saving enough. It was not those things. Let me show you what it actually was. Level 2 is where the story changes. Because while families were getting priced out, something else was happening simultaneously, and it is documented. After the 2008 financial crisis, we'll come back to 2008 properly in a moment, home prices crashed. millions of families lost their homes to foreclosure. Entire neighborhoods in Phoenix, Atlanta, Tampa, Las Vegas were sitting on distressed properties that nobody was buying. In 2012, Fannie Mae, the government-backed mortgage company, placed thousands of foreclosed homes for sale in bulk, not to families. In bulk institutional transactions. A private equity firm called Blackstone saw an opening. Between 2011 and 2013, Blackstone spent an estimated $10 billion buying foreclosed homes across the country, eventually creating a company you may have heard of, Invitation Homes. Today, the largest single-family landlord in the United States, owning over 80,000 homes. Now, before I go further, I want to be precise about something, because this part of the story gets distorted in both directions. Institutional investors currently own less than 1% of single-family homes in the U.S. Their purchases have dropped over 90% since 2022. If you've heard that Wall Street bought up all the houses, that's an overstatement. The core driver of the affordability crisis is a supply shortage. The U.S. is roughly 4 million homes short of what demand requires. So the institutional buyer story isn't really about market share. It's about what those purchases proved was possible and who was watching. When Blackstone bought those foreclosed homes, homes that had been owned by middle-class families in the same neighborhoods where those families had just been foreclosed on, they demonstrated something the entire financial industry saw clearly. That single-family homes could be financialized, packaged, securitized, sold to investors as bonds, the same way mortgages had been sold as bonds before 2008. A house stopped being just a place to live. It became an asset class. And once something becomes an asset class, the rules of that game apply to it. And the people who know those rules have a permanent structural advantage over the people who just want somewhere to live. By January 2017, Fannie Mae provided a $1 billion loan backstop to Invitation Homes. The same government entity that bailed out the mortgage market provided a $1 billion loan backstop to Invitation Homes. The government-sponsored entity that exists to help families buy homes gave $1 billion to the largest corporate landlord in history. In the same neighborhoods where families had just lost those homes to foreclosure. I'm going to say that one more time because it's important. The same families lost their homes in 2008. The same banks got bailed out in 2008. And then a government entity gave $1 billion to the company that bought those foreclosed homes and turned them into rentals. That is not a broken market. That is a transfer of wealth. And it was documented at every step. Before level 3, I need to show you something, because everything so far, the prices, the institutional buyers, the bailout, if I just keep going, it sounds like a sequence of bad luck. It isn't. This was built, step by step, over decades. I'm going to read you the timeline. 1986, Congress passes the Tax Reform Act. It extends the depreciation schedule for rental housing from 19 years to 27.5 years. That one change reduces the financial return on building affordable rentals. Developers stop building them. The supply starts shrinking, not because of demand, not because of the market, because of a line in a tax bill. 1994 to 2006. Banks discover they don't have to hold the mortgages they write. They can package them, sell them to investors, collect the fees, and move on. The moment that happens, the bank has no reason to care if you can actually repay. The risk is someone else's problem now. 12 years of this. Building pressure, invisible to anyone not watching closely. 2008. The pressure releases. 10 million American families lose their homes. The government spends $700 billion, not on the families, on the banks. The same institutions that packaged the bad mortgages and sold them to investors, they received the rescue. The families received a program called HAMP. It was supposed to help them stay in their homes. It reached a fraction of who needed it. 2011 to 2013. Interest rates are near zero. Home prices are at decade lows. The Federal Reserve's cheap debt is available, but not to families trying to buy. To institutional borrowers with capital market access. Blackstone enters. $10 billion. tens of thousands of homes, many of them in the same neighborhoods where families had just been foreclosed on 2020 to 2023. Pandemic-era stimulus drives home prices up 60% in 3 years. Then, the Fed raises rates to fight inflation. Anyone who refinanced at 2% in 2020 will not sell. They can't afford to give up that rate. Inventory freezes. Prices stay elevated. The buyer today faces a price 60% higher than 2019 and a mortgage rate more than double what it was. Every single one of those events was a decision, a policy, a regulation, a line in a bill. Markets respond to incentives. The incentives were set by people. The people who set them were not the ones who got priced out. Level 3 is where most housing conversations refuse to go, because it requires naming something that makes people uncomfortable. The American housing market is not a free market. It has never been a free market. It is a heavily legislated, heavily subsidized market, and the legislation and subsidies have consistently, over decades, favored asset holders over first-time buyers. Let me give you 3 specific examples. The mortgage interest deduction. Since 1986, only home mortgage interest is deductible, not consumer debt, not rent. This is a subsidy that exclusively benefits homeowners. The bigger the mortgage, the bigger the deduction, which means the biggest tax benefits go to the people buying the most expensive homes, the people who could already afford to buy. Zoning laws. Approximately 75% of residential land in American cities is zoned exclusively for single-family housing. This is not a natural market outcome. It is a legislative choice made by local governments, often explicitly to limit density and protect existing property values. It means you cannot legally build an apartment building on most residential land in America. It means supply cannot respond to demand. It means prices go up, and existing homeowners whose net worth is tied to their home's value benefit directly from that. Think about what that means for one specific person. A teacher in Austin earning $62,000 a year. There's a vacant lot 2 blocks from her school. A developer wants to build apartments she could afford. The city says no, wrong zone, wrong density, not consistent with neighborhood character. The land exists. The demand exists. The developer exists. The law says no. And the teacher keeps paying $1,800 a month in rent, while her landlord's property value, protected by that exact zoning law, climbs every year. That is not a free market. That is a managed market, managed in favor of people who already own. The capital gains exclusion. If you sell your primary residence, the first $250,000 in profit, $500,000 for a couple, is completely tax-free. This is a policy that exists exclusively for asset holders. It makes housing a uniquely tax-advantaged investment, which means money flows into housing as an asset, not just as shelter, which drives prices up further. For people who don't yet own, this creates a self-reinforcing loop they are outside of. None of these policies are secret. They're in the tax code, in municipal zoning ordinances, publicly available, and they were written, every one of them, with lobbying input from the real estate industry, the banking industry, and the home builder industry. Not secretly, through the normal legislative process. The outcome is a housing market where the rules were written by people who already owned assets, for the benefit of people who already owned assets. And the people who don't own anything yet are told the problem is that they need to save more. I want to be honest with you about why I made this video. It's not to make you feel powerless. The opposite. The story you've been told about the housing market, that it's about supply and demand, that it'll correct eventually, that the problem is you don't have a big enough down payment. That story has a function. Its function is to make a policy problem feel like a personal problem, because personal problems don't require systemic solutions. But when you can see the 1986 tax code and the 2008 bailout structure and the zoning laws and the capital gains exemption as a connected system, built over decades by identifiable people for identifiable beneficiaries, it stops being a personal problem. It becomes something you can actually understand and push back against and vote on. So here's what I want you to do with this. 1. Know your actual number. Go to the Atlanta Fed's affordability calculator. Put in your income. Find out what home price you can actually afford at today's rates. Most people haven't done this because the answer is uncomfortable. Do it anyway. You cannot navigate a system you won't look at. 2. Look up your city's zoning map. Almost every city has one online. Find out what percentage of your city's residential land is zoned single-family only. That number is a direct measure of how restricted your local housing supply is and who your local government has chosen to protect. 3. Follow what happens to the low-income housing tax credit. It's one of the only federal programs that actually builds affordable housing. Every time it gets cut, tens of thousands of units don't get built. It almost never makes the news. It shapes your city more than almost any other policy decision. The housing market isn't a weather event. It isn't a natural disaster. It is the output of decisions made by people who are still making decisions. That means it can be changed, but only by people who understand what they're actually looking at. Now you do. If this changed how you see the housing market, send it to someone who's been told they just need to save more. That's who this was made for.